On the agenda tonight, Jay Powell whacks the stock market as he refuses to deliver another hit of the good stuff.
I can't go down through this flooding 3 feet of water down there!
I will not die sober!
One of the most reliable recession indicators in history has been triggered. Is it time to grab the diaper?
And now, the end is near.
The market awaits the Iranian response to Israel. Are we on the verge of World War III?
War is a continuation of politics by other means.
And in a confirmation of the market top, legendary investor Warren Buffett dumps stocks like never before.
Sell it all today.
All right. Today is Sunday, the 4th of August. This is a recap for the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. Hope you're enjoying the Olympics. I'm watching some stuff here and there. A lot of interesting stuff been going on. A lot of controversies, a lot of memes, a lot of stupid things being said online. But my favorite moment is this guy, the Frenchman, who was supposed to win a gold medal, and then he hit the pole with his schlong and lost it all. What a dick move. But you know what's more interesting than the Olympics? It was the stock market, because what a week it was. We're just beginning the month here, folks, and the first 2 days, the Nikkei down 8.2%, the worst ever in history. The Russell 2000 down 6.4%, the worst drop in history. European stocks down 3.9% in 2 days, the second worst ever. The Nasdaq down 4.7%, the second worst ever. The S&P down 3.2%, the third worst ever. But rest assured, folks, your beloved media says, don't panic. There's no need to panic right now. Just grab your blindfolds and keep buying the dip, please. We're not finished dumping on your head yet. Just a little more, then we'll be done. Somebody pretty please in the audience, because I don't have the time here. Can you please look at the headlines just in the last, let's say, 2 to 3 weeks that says, no need to panic? Because I've seen a lot of them in the last 2 to 3 weeks. Here's an example for you. The Journal says the Fed is behind the curve. There is still no need to panic. You got Market Watch saying a viral chart suggests a recession is coming after the Fed cuts interest rates. But don't panic yet. You know, when the beloved media, the propaganda media that we have in this country says don't panic, yeah, it is time to panic. But somebody please grab some of these headlines and send them to me. I'll send you a cookie as a thank you. Maybe we should listen to somebody like Bill Gross, who, by the way, lives up to his name, but he says, is any media figure willing to say, quote, bear, end quote? Very few bull stocks these days. Pipeline, MLPs, banks, financial in general. Investors should stop talking about buying the dip and start asking about selling recoveries. Uh-oh. And there was an important reason, folks, on why the dynamic all of a sudden changed. I told you, look, when the market in a bubble and everything is going crazy, it seems irrational and nothing really matters. Shake it off, baby. But when things begin to matter, they get ugly really fast, and the drops keep happening, and every time you think it's oversold, it keeps going down. And it happens so fast you can't even wrap your head around it. Those who say, oh, we're just going to buy the dip, they get slaughtered right away. And the pussy bears who, do I short now? Or do I wait for a rebound? They get slaughtered too. Action time, baby. Either you're in, or you're just going to be either a spectator, which is a lot better than being a victim. Because we're going to see a lot of victims when this is all said and done. But the reason why the dynamic changed, folks, we go back to the wall of hope. We got 2 items in the wall of hope, the Fed cutting rates and the AI mania, and both of them got slaughtered this week. You got your boy Jay Powell. He whacked the stock market. Why? What is the surprise here? Because Jay Powell said that, sure, maybe September, we're going to do the rate cuts. Nobody was really anticipating rate cuts in July. But I told you folks that the market behavior, with the IWM rallying 10% and all of that, they're anticipating a rate cut in July. And at the end of the day, when the rate cuts happen, they'll happen for the wrong reason. And that was another realization. Now, the media and the talking heads and the economists and specifically The banksters and the Wall Streeters, oh, they'll come out with the knives now. The long knives are coming for J. Powell. Why did you wait? You made a mistake, yada, yada, yada. These are the same folks, by the way, who've been saying, oh, soft landing is coming, the economy is doing great, and the consumer is robust. Now they're begging Jerome Powell for interest rate cuts. I say be careful what you wish for. You cut the rates, it will be a confirmation that the economy went down the toilet. But let's go back, folks, and revisit the conversation that we got from last week. The anticipation was if the Fed holds rates, we have two outcomes. Are they holding rates because they need to see more or inflation risk? It doesn't matter at the end of the day. Powell said he needs to see more. And I said, no, he's waiting for the shit to hit the fan, and then he's going to cut rates. And now, as you can see, the shit is hitting the fan, and we get a mess all over the place. But anyhow, the anticipation was that the dollar would go higher, yields would go higher, and then we'll see the rotation going kaput. And we depend on two things. If tech earnings come out good, we rotate back to tech. If tech earnings are not good, we rotate to the dumpster. Sell it all, baby. And it appeared that it's going to play out this way, where the dollar and bond yields went down initially, but then overnight began a recovery. And Meta came out with good earnings, and Meta was going higher, and Nvidia went higher during the FOMC day by over 10% plus. Meanwhile, the IWM faded the pop after the FOMC. So it looked as we get into this scenario. But then there was a piece of data that came the day after, Thursday, that moved the dynamic as if the Fed announced cutting rates because of fear of recession, and the dollar bond yields collapsed. And we've seen the risk-on rotation, of course, going kaput, while the risk-off rotation of value stocks, but specifically dividend-paying stocks, actually outperforming. You'll see that in a minute in the heat map, because the headlines, the world is ending, right? The stock market is crashing. But there are stocks that actually gained during this week. Now, the Fed didn't cut rates for the wrong reasons, for fear of recession. So why did we go to that scenario? I think there was panic because of the data. In the bond market, the reaction was, Mr. Powell, you made a mistake. You should have cut. You did not, so we're going to cut for you. We're going to go ahead and buy bonds like crazy in a panicky mode and crash yields across the curve. We'll do the cuts for you. We're sending you the message now, so you can do it. And folks, last week, the thumbnail of the video was, do it, Mr. Powell. I dare you to do it. And I'm the king of bears. And I still wanted to see Jerome Powell cutting rates in this meeting. Not because I want the market to go higher, but I wanted you to see how the duality of the risk will play out. Because we've been talking about this for a while. And folks say, oh, it doesn't matter. Stocks just go up. Nothing really matters. Janet Yellen got it. Biden will manipulate the stock market and the economy till the elections. All of that stupid talk. But I told you there was a duality of the risk. Every single time we're at the same point in this cycle. Every single time. You got your inflation risk and you got your recession risk. And you have to sacrifice one to remedy the other. So either you go with, I'm going to tackle inflation and the cost is recession, or you tackle recession and the cost is inflation. You can't win both. And the sooner you realize that and you choose one way versus the other as a Fed chairman, the milder the consequence would be. Example, we got an inflation problem that began with the stimmies on steroids and the printing of money, trillions and trillions of dollars by the Fed. Okay, now you know what you need to do. We have an inflation problem. What is the reliable remedy for inflation? It's a recession. And the sooner you do it, it'll be a mild recession. Stock market goes down 25-30%, but inflation is out of the economy. But it is the pursuit of the fantasy that's going to kill us. Thank you to the delusional madman Jerome Powell, who wanted the soft landing. Never happened before, but it is the ego that wants to pursue the fantasy and lead us to one of the hardest landings ever. He wants somehow to get rid of inflation without a recession in the economy. And now we're all realizing, even Powell now realizes, the duality of the risk, that you got your recession risk, your inflation risk. Now the recession risk becoming more dominant, but your inflation risk is not going away. And if you cut rates right now to remedy the recession risk, your inflation risk will come back with aggression. There are warning signs already. Everybody's looking at the recession risk right now, but you will see the inflation risk the moment the Fed begins cutting rates. And that's what really crashes the market, because the market looks as, okay, we're going to cut rates, everything is going to go back to hunky-dory now. But then you realize that, oh my God, inflation is coming back up. Now they can't cut, so the economy will continue to get worse. But they can't cut with aggression because inflation comes back. That's the moment of panic, as we've seen in 2008. And the data that we got this week that rattled the stock market and every economist's expectations and finally validated what we've been talking about in this channel for a long time, which is stagflation. This data was the manufacturing ISM. See, the headline reading in the PMI was down 1.7 points, new orders down 1.9, production down 2.6, so the pace of economic activity is dropping down dramatically. The most shocking piece was employment. Employment down 5.9 points month on month. Here comes the layoffs. Now, if all of this was happening while prices were going down, then okay, at least we're getting a recession, but inflation is getting out of the picture too. But look at prices. Prices actually went higher month on month. That's the moment when the market realized that it's because you got the worst of two worlds. You got the duality of the risk right here, recession and inflation. And we said before in the program, we're going to rotate into a recession. That's the reality. The whole rotation to small caps and risk on is a fantasy. It's stupid fantasy, really, because you're betting on the soft landing. If you think that we're going to rotate to the small caps and the profitless companies, you're assuming that we're going to have rate cuts because we've defeated inflation. And there is no recession risk at all. These kind of talking heads are betting on the scenario of 2018, 2019. I'll give you a minute here to realize what is the difference between now and 2018, 2019. And everything got exposed this week, that you can't really rotate into risk-on or profitless companies. Those companies are zombie companies, and they're going to go bust when this whole thing is done. And I told you before in the program, you got to use the rotation in your advantage. Certain names will go higher, and they will still go higher because they have certain tailwinds, dividend-paying stocks, for example, with good profits. Those are good. You stick with those. But you look at other rotations into the risk-on segments and the profitless companies as an opportunity to short. And if you took advantage of that, you got rewarded. Here's the other piece of data that rallied the market. Now, we talked about the stagflation risk with the PMI. Employment down 5.9 points, but you got prices going higher. The employment warning showed up in the payrolls data. When you look at it at face value, the economy created 114,000 jobs. So what is the problem here, Maverick? We're not seeing any problem. The economy is still creating jobs. Where is the panic coming from? You look at the details, education and health, 57,000 jobs, construction, 25,000 jobs, leisure hospitality, 23,000 jobs, government, 17,000 jobs, retail, 4,000 jobs, manufacturing, 1,000 jobs. We only lost in business services 1,000 jobs. The pace of hiring slowed down dramatically, but we're still net creating jobs, according at least to this fake report. What really freaked out the market is the fact that the unemployment rate is rising higher. We're now at 4.3, the highest since 2021. Now, you got to keep this in mind because it could be a false alarm with this jobs report. I disagree because we looked at the PMI and we look at corporate earnings every time in this channel. And I explained to you folks how the dilemma that most corporations that are dealing with the consumers, the biggest dilemma in these corporations, revenues are slowing down because consumers are getting weaker. They're not spending anymore. Prices are way too high. So the remedy would be for them to lower prices in hope of getting higher volume again. And that will somehow make up for it. It's not working out. They're cutting prices. Their margins are getting worse. Okay, what do we do next? Because costs are not coming down and they can't really control costs. If you have energy costs going higher, that's out of the hands of corporations. If you got sticky inflation, that's out of the hands of corporations. The only thing they can really tackle in this situation is getting rid of expenses, reducing expenses. The easiest way would be reducing the headcount. And that's going to lead to higher unemployment in the economy. As companies now look to improve their margins, the only avenue they got left is get rid of some employees. But you got to keep in mind that we've seen at least 500,000 people saying that they were not at work because of bad weather in July. You got the storm in Texas and then the record heat in the West. Did that contribute to higher unemployment rate? Could be. But again, you look at the other evidence, the cumulative evidence, we're heading that way anyways, bad weather or no bad weather. The other thing is when you look at average hourly earnings, we're going down now 3.6%. So whatever advantage employees had over inflation, that's going to shrink and go the other way. Because in my assessment, I think that the moment the Fed cuts rates, inflation will come back. And then the gap between wages and inflation will widen again in favor of inflation, meaning that the consumer will get hit even harder. Not to mention, of course, the dynamic with the Bank of Japan and the Japanese yen. We'll talk about that in a minute. But let's go back to the question here. Maverick, 114,000 jobs. Why are we freaking out right now? Because there is an important indicator that got triggered this week, a reliable recession indicator. It's called the SOM rule. It is named after economist Claudia Sahm, who used to work in the Federal Reserve. Used to be one of my favorite economists until she became a propagandist for the regime. And that's what really happens when you graduate from academics or the Federal Reserve, and then you begin working for Wall Street. You sell out and you become a propaganda machine yourself. And that's what happened with Claudia Sahm. But anyways, her rule has been triggered, meaning that we have a recession coming to the economy in less than 8 months. We will begin seeing the recession in reality. You can see here, going back in history, every time we got the SOM rule getting triggered, few months later, The longest period was 8 months. Then we got the recession right away. So we're now getting really, really close to the beginning of the recession. And of course, we know that the stock market crash precedes the recession in most of these instances. Now, the problem with Claudia Sahm is she's been saying that her base case is soft landing and the economy is doing better than ever before. And even though her own rule got triggered, that a recession is coming near the corner, she says, oh, this time really could be different. Really? Could be different? Then why are we listening to you and your stupid rule if it's going to be different this time? The problem with Claudia is politics got in her head. And now, instead of just sticking to the data and the facts, she wants to be political too. And that's her Achilles heel. You can't really violate your own rule just because you don't like the outcome, because it's going to hurt your politics. She said before, when we got the polls, that the majority of Americans say that the worst off financially under Biden. We know why. It's an economy that works for the super rich, the owner class. But for the regular working class, it doesn't really work. You can't afford homes. You can't afford groceries. You're getting buried in debt and higher rates, and you can't catch up with the bills. Of course, folks are feeling bad. Claudia Sahm says, oh, the vast majority of Americans are better off financially. Full stop. So she's gaslighting all of us. She says Bidenomics is an easy sell if presented broadly. You mean the biggest income inequality in history is not really catching up with the population because it's not being sold properly. Again, the gaslighting is on another level. And then she says, oh, I'm tired of deleting death threats on Twitter or X, whatever you want to call it. My hunch is maybe we got some crazy people doing death threats, but the majority are criticizing her to her face, that you're gaslighting me while I'm hurting. We're telling the truth. You're just living in another bubble. Maybe you should get out of it to see the reality. When you say Americans have never had it so good, but they refuse to admit it, who the hell do you think you are? Look at the delinquency rates. Look at folks getting buried in debt. Look at an entire generation who cannot afford homes anymore. The American dream is dead for them. An entire generation who's passing on having kids because they cannot afford them. And you're telling me that we have it so good, we just refuse to admit it. Pretty please, but off. You and your stupid rule anyways. And by the way, again, don't panic, right? Don't panic. Yeah, the rule has been triggered, but it could be different this time. And you got, of course, propagandist Paul Krugman, who should be stripped out of his economic Nobel Prize, because the guy is just a troll at this point. He says, keep some and carry on. You don't need to read the article. You can wipe your ass with it if you have any shortage of toilet paper. But in a nutshell, he says, yeah, the rule has been triggered, but it doesn't really matter. Now, folks, forget about the Sahm rule and all of that bullshit. I gave you the math rule, and this was back in December, baby. I told you the Sahm rule actually got triggered. In reality, because of my indicator. And my indicator is, as California goes, so goes the nation. In a nutshell, here's something really important for you to understand. We've been talking about this for a long time, that the unemployment rate is a lagging indicator. Unemployment doesn't rise until we're already in a recession. You're not going to notice the layoffs until we're already deep into the recession, until we're already past the market crash. Go back to the early 2000s. Market crash was early 2000. Unemployment rate didn't go higher at that point. It began to go higher, noticeably higher, as the recession was already ongoing. So you can't say that we're not in a recession because unemployment is so good, or because we're creating jobs, because that's bullshit. Unemployment is a lagging indicator. What you need to look at is the change year on year in the unemployment rate. When you do that, what do we get? You see that we're going back to positive. That's the warning. But we got to that territory in the early 2000s before we've seen a rise in the actual unemployment rate. Another example for you. Here's the unemployment rate during the recession in 2008. You can see, yes, the unemployment rate has been rising higher, but it didn't really spike significantly higher until after the market crash, and we've already been in a big recession. Then unemployment spiked higher. But if you looked at the change year on year in the unemployment rate, when did it get above zero? In 2007. That was the warning sign that it's going to happen. Let's go to what we have right now. The change year on year in the unemployment rate. When did it go positive? That was in the first quarter of 2023. But was anybody paying attention at all to what we've been saying? Of course not, because you got the two magical words, the distraction, so they can transfer the wealth. AI. Nothing really matters. It's different this time. But the warning sign was here. And of course, the change year on year in the unemployment rate in California been positive way before 23. And every time it moved to positive, it was the leading indicator that the nation is next and there was a recession coming. So we explained all of this to you guys a long time ago. And lastly, you look at the unemployment rate versus the yield curve. Every time we have a steepening from inversion, meaning the red line goes from negative to positive, that is also a confirmation that the recession is coming next. And if that was not enough, look at Chapter 11 filings, the highest level in more than a decade. So we know that the recession is now in the bag. So when we go back to the wall of hope, the rate cut hope has been completely neutralized now, because even if the Fed cuts rates, we now know for sure that they're going to cut rates for the wrong reasons. By the way, in response to a post by Peter Schiff saying that we might see an emergency meeting where the Fed is going to cut rates because they're going to blame Powell. The long knives are now coming for Powell. And he might say, okay, I'm just going to announce an emergency cut. If that is the case, then it's going to backfire because the market will look at it as panic. We're going to have a 2008-like reaction. It's not going to help. So now Mr. Powell boxed himself in a corner. He didn't cut. He can't cut between now and September. So whatever pain we get in the economy, we just have to deal with it until September. And at that point, it might be too late. So it is a bad situation. But for folks who say, oh, rest assured the Fed will come out with an emergency meeting and just cut rates, well, now the rate cut optimism has been neutralized. You actually don't want to see rate cuts. You better hope that the services PMI coming out next week and the other data show that the economy is still hot. At least the services sector is still showing up with growth in economic activities. You better hope that's the case, because the moment we get rate cuts, it's panic all over the place. So what do we have else on the wall of hope? We got the AI mania. Let's see what's going on with that. So we talked about peak earnings by the big cap technology companies. We gave you Meta, for example, the net income. Still impressive, but it's been declining. We've already seen the peak. This is as good as it's already going to get. And from this point on, net income growth is going to continue to go down. And the worst possible scenario is if the economy weakens and advertising spending goes down, then the net income will collapse more rapidly than we anticipate. And the same thing with Amazon. The AWS cloud revenue is doing pretty good, but then you look at the growth in net sales. We've already peaked and now we're going down. You look at net sales international, same thing. We've already peaked in Q4 23 and now we're coming down. You look at Microsoft, it's the same thing. You got the Azure growth holding, that's the B2B spending. Those are not being hurt at all. But then you look at the revenue growth, net income growth, those have already peaked and now we're heading down. And you see the same thing in Apple. So even the strongest companies in the world right now are showing signs of peaking, and that the majority of the good news was already priced in, and now we have a case of overvaluation, because what's going to come next with the weakness of the economy is not being priced in. So we have to price that in the stock prices, and that's why they're going down, despite quote-unquote good earnings. That's in the rear view mirror, though. It's already priced in. Now we have to price in what happens next. Then you look at the not-so-strong companies like Intel, for example. Existential crisis. It lost over a quarter of its value within 2 days, ladies and gentlemen. The worst fall in 50 years. One of the most iconic American companies might go bust. And by the way, it never really recovered from the top of the dot-com bubble. So you see now damage even in the technology sector, sometimes more severe than others. But of course, all eyes and all hope that is left in this economy and the stock market is NVIDIA, what initiated the mania. The problem with NVIDIA is it's already in a bear market. It already lost about $800 billion worth of value. And even Elliott came out this week and they said that NVIDIA is in a bubble, AI is overhyped, there's no way we're going to live up to these valuations. We're going to see peaking in revenue, peaking in net income, and everything will go down from this point on. Same thing we've been talking about in this channel for a long time. On top of that, NVIDIA is now probed by the Justice Department. We talked about the export restrictions on China. So the doors are being closed. And on top of that, perhaps the worst news that we got is even the hope that maybe if they come out with the Blackwell chips, lower priced, but they can sell more of them, maybe that's going to reignite the AI mania. But now we got the news that the new AI chip by NVIDIA is delayed due to design flaws. And guess who knew that ahead of time and began dumping stocks? It's the rats at NVIDIA, the executives. They've been dumping with insanity. Tens of millions of dollars every single day. And your boy Jensen Huang, the CEO of the company, oh, he's dumping like never before. And he should, to be honest with you. He won the lottery. Why not? I mean, the guy cooked the numbers and the data and initiated one of the craziest bubbles in history, perhaps the biggest bubble in history. And now he needs to cash out so he can buy new leather jackets. He got this Tom Ford Lizard jacket with the collar, which, by the way, costs more than your home. And then he got the one without the collar. Now he got the other one with the collar, but without the lizard print, just in case he's not feeling lizardish on that day. He got the one with no lizard without the collar, but he needs more. The guy needs more leather jackets. They cost, what, 25 grand a pop? He needs to dump more. What is it with these tech oligarchs? You know, they all grew up as nerds. They got bullied in the schoolyard. And now they want to act as badasses. You know, leather jackets and learn martial arts. Even Zucchiniberg is now donning the leather jacket. He wants to look like a badass. He's fighting UFC all of a sudden. He's supporting Trump now. He's calling Trump a lot lately. He's not going to vote Democrat anymore. He grew a beard. He got the necklace thing. He wants to look like a badass to compensate for being a dorky nerd for his entire life. My hunch is Mr. Zucchiniberg is going through a midlife crisis. And soon enough, I'm betting on that outcome. He's going to bang somebody else. And there's a divorce coming, just so you know. So he's just preparing now for the splitting half of the money. So he's dumping more and more as we speak. And these billionaires, the owner class, they use the bubble, which, of course, you guys have been jerking off to it because you got paper gains. You haven't even locked your gains, and you think you got rich. At the end of the day, you're going to realize that you just participated in the most expensive roller coaster in history, while the insiders use the bubble to dump and get rich in liquid cash. I mean, even drunk Michael Saylor, who talks about, Bitcoin and all of that, and the fiat currency is going away. Why is he dumping shares like never before then? So he can get rich in the worthless fiat currency. All of these oligarchs are dumping, folks. And some of them having disturbing behavior, like the Bezos of the world, buying ranches in the middle of nowhere. You got Bill Gates buying farmland. You got the trend of these oligarchs buying land in Hawaii and building doomsday bunkers. What the hell is going on here?
Because the hottest trend is billionaire survivalist bunkers. Only two things in life are certain, death and taxes. And billionaires have figured out how to cheat both.
I tell you what's going on. What's going on is we're going to have the biggest economic disaster that you have ever seen. And after that, of course, people are going to revolt. We got played. We got duped here. We got nothing out of it. There will be a revolt against the oligarchy. But guess who's going to win with the AI and all of that? The oligarchy and the government. We're going to defeat the rebellion. And then since AI replaced all of the jobs, you got all these people with no homes, overpopulation really. They can't whack you with another virus and all of that because, now people are aware of all that stuff. So they're going to give you UBI, Universal Basic Income. You're going to live in these capsules in the new dystopian world. And Elon Musk will have the chip in your brain thingy. So even if you think, not even tweet it, but if you think anything bad about the government or the deal leaders, they deduct your points away, your social score. You don't get UBI anymore. You can't get out of your capsule and go to the government buffet to eat, because you got no credit anymore. If you think about stealing, the cops will get you because the chip in your brain thing, you remember? AI, baby. But inequality will exist even in this dystopian future because some of the population will have capsules with a view and some sunshine, others will not. So if you behave pretty good, they'll give you a capsule with a view and some sunshine. But rest assured, folks, if this scared you, oh my God, we're going to live in capsules and have this dystopian future. We worshipped Elon Musk and turns out he's going to work with the government to oppress us, right? There is another, maybe better outcome from all of this, which is when the economic crash happens, they might send you to die in Iran. Much better than living in a capsule, right? And that leads us to the wall of worry. So we talked about what changed the dynamics in the market this week. The elimination of the wall of hope, rate cuts, that's kaput now. Even if it happens, it's actually going to be worse. And the AI mania, that's poof, gone. We've already seen the peak, and from this point on, it's going to get worse. At the same time, we have some items in the wall of worry that flared up dramatically. And the two important ones, the geopolitical risk, what happened with the Bank of Japan. Let's begin with the geopolitical risk. So we're now waiting, everybody's on pins and needles, we're waiting for the Iranian response to Israel. The talk is this time around it's going to be serious. We're going to have serious consequences, a real attack on Israel. Okay, so now we have the United States deploying ships, fighter jets to the Middle East in preparation for the Iranian attack and perhaps the war that's going to follow thereafter. We talked about the tensions, by the way, between the United States and Israel, and I told you from the get-go, this guy is a lunatic. He's a madman, Netanyahu. He's going to go as far as he can in this war. He's going to pick up a fight with anybody, everybody, because he knows that he got our donkey politicians in his pockets, and they will follow whatever he wants. But maybe we're beginning to sense the risk here, that we might be dragged into a major war. And even the New York Times says that Netanyahu, they say defiant because they have to kiss his ass, but then they say appears to have gone rogue. That's an interesting choice of words. Not me saying that, it's the New York Times. Risking a regional war. And now Biden, I don't know if he's alive or not, if he's aware or not, because last time I saw him on TV, he was out of it. It appears that Kamala Harris is running the country right now. But even the Israeli media says that Biden realized that Netanyahu lied to him about the hostage deal. And he called Netanyahu recently and said, "Stop bullshitting me, Jack. Don't take me for granted." And then he sent another $60 billion and more ships and fighter jets to protect him. And Netanyahu knows he played Biden like a donkey. He knew that at the end of the day, we'll go with whatever he wants because we have no balls left. And if this response by Iran is a serious response as we anticipate, and Israel decides to go in a head-to-head war with Iran, they're not going to do it alone. We're going to be dragged into it, baby. What do you think will happen to the global economy at that point with the spike in oil prices and the sea shipping routes being closed and all of? What do you think will happen? It will be economic devastation like we have never seen before. What really worries me, though, is this thing morphing into World War III or a nuclear war. And I think, and I've been saying this for a while, the war in the Middle East and the war in Ukraine will overlap at some point. And the common denominator in both is Russia. Now, I want you to hear this tweet from former president of Russia, Medvedev, who's a lunatic, by the way. I mean, if this guy was in charge, the nukes were already been flying a long time ago. So maybe we should be thankful that Putin is in charge and not this guy. But he says the knot is tightening in the Middle East. Sorry for the innocent lives lost. They are but hostages of disgusting state, the USA. Meanwhile, it is clear to everyone that a full-scale war is the only way to shaky peace in the region. Unfortunately, I agree with this assessment that the only possible scenario right now to cool things off is huge escalation. The problem with that is miscalculations. What do I mean by that? If Iran hits Israel with a mediocre hit, Israel will hit back. They're not going to be deterred. They'll do it again. They'll assassinate within Iran. They'll hit within Iran. So the response has to be big. We know that Russia is relying on Iran right now. They're not just going to watch and see them collapse or get defeated. What if Russia delivers a nuclear device to Iran? And the Iranian response would be shooting ballistic missiles into Israel. Some of them land. And then they do a display. They test a nuclear bomb that is delivered by the Russians as a message to say, hey, our missiles hit you. And the next one will have a nuclear warhead in it. What do we think the Israeli response would be? They have to show their nuclear card too, which is blowing up a tactical nuclear weapon. Is it going to be a test or is it going to be an attack against Iran? Maybe it is a test, and Iran blows a nuclear weapon coming from Russia, and Israel blows up a nuclear weapon coming from the US, and that escalation will just keep it out as it is, and we have a shaky peace in the region. That everybody knows that the stakes are big now. But any miscalculation, and now we can talk about nuclear war, we can talk about the involvement of Russia, because you got to remember, Russia has bases in Syria, and if they ally themselves with Iran, and Iran hits Israel, how would Israel respond to Russia? How would the US respond to Russia? I think it could be within Syria, and Syria becomes a theater of war between huge global powers. And the Russian presence in Syria is not small. They have strategic bombers, jets, tanks, troops by the thousands. So it's not looking good, folks. And that's my fear, that it goes out of hand. It's already getting out of hand. So somebody got to do something here to stop the insanity. But suppose we get an escalation, and it is a serious one. The two avenues you can play as an investor is oil and the defense contractors, let's say Lockheed Martin, because that's the one that we usually go to. And by the way, a lot of unusual activities in Lockheed Martin. A lot of buying of calls out of the money in Lockheed Martin. So something is going on here. But which one is better than the other? Because if you look at oil, the bullish case for oil is we get a rate cut. Oil loves rate cuts. Every time the Fed cuts rates, oil goes higher. Wrong reasons, right reasons, doesn't matter. But at the same time, oil has an enemy, which is a recession. Investors, they dump oil once we have any recession fear, as we've seen this week. So it kind of goes against each other. That yes, we have a rate cut coming, but fears of recession might hammer oil. And this makes it a timing kind of play. That until we get the rate cut, maybe oil is not the better investment. After the rate cut, oil might shine. Of course, if we have a huge hit, maybe at the time I'm speaking right now, by the time the video is out, we have an Iranian response and it's huge, and we see oil rallying by 5, 6, 7% overnight. That's a possibility. But then you look at the other case of the defense contractors. They thrive under rate cuts because they're dividend-paying names. So when yields go down, we flock to dividend-paying names and we look for high-quality dividend-paying names. And if you have weakness in the consumer, would you go with utilities? Maybe, but they're going to suffer too. Would you go with the staples like Procter & Gamble or Kellogg's? Maybe, but they're going to suffer by the recession and the consumer weakness too. Who doesn't suffer? The companies relying on government spending. That's the defense contractors and big pharmaceutical companies. that pay high dividends. So this is a bullish case for Lockheed Martin. The recession is not a major concern unless we have government cutting spending. So that's not in the immediate risk. The immediate risk for Lockheed Martin is peace. And are we really betting on peace? Not really. At least not after a major escalation. So for me right now, the defense contractors make more sense than oil. But oil will shine once we have rate cuts in the picture. And if you want to pick in the companies, this week we got Chevron versus Exxon. Chevron net profits are down. They are relocating from California to Texas. Makes sense, but again, net profits down. On the other hand, net profits in Exxon went higher. So definitely Exxon over Chevron if you're going to pick the stocks. The other item in the wall of authority that flared up was the Bank of Japan. So we know that the Bank of Japan, we've been talking about this in a while now, and I said, I promised the Bank of Japan, you can spend billions of dollars. It's all going to go down the drain to prop up the yen. The only solution that would work and stick would be raising interest rates higher. That's when the yen will find a major footing. But at the same time, as the yen finds a major footing, the rally in the Nikkei will become a crash in the Nikkei. And with that, of course, we see the correlation of the Nasdaq Nikkei. And the viewer here says, thank you for the comment, by the way. You go back all the way to the 20 teens and the correlation between the Nikkei and the Nasdaq. And if we see a crash in the Nikkei, does that mean that we unwind the entirety of the rally in the Nasdaq? Look, one step at a time. Here's what we know. I've been showing my viewers this throughout the week. You got the Nasdaq in candlesticks, you got the Nikkei in white. You see the correlation is clear. And the Nikkei have been getting crushed as an indicator, leading indicator, that the Nasdaq will follow. Until we find a footing in the Nikkei, we're not going to find a footing in the Nasdaq. And sure, you can go all the way back, not just to 20 teens, you can go back all the way to 1990s. The Nikkei and the Nasdaq have been trading together. And again, we can make a whole video about why that is, even though the currencies go the other way. So why do we see the correlation between the two markets? Again, topic for another video. But the point being here is, and we talked about this again in the past, that at some point we'll see sort of a war between the central banks, a conflict of interest between central banks. Look at what's going on right now as an example. Japan says, you know what? We can't just stay like this anymore. The currency is crashing. We have to do something. So they're increasing interest rates and they're slowing down their bond purchases programs overseas to help the yen go higher. And the yen is going higher. The problem is if the yen goes higher, the dollar also goes weaker. And if the Fed cuts rates to remedy the recession that we have here in the US, while the Bank of Japan continues to raise rates, what do you think the outcome will be? Yen going higher, dollar collapsing, and the outcome will be commodities going higher. And that's not good for inflation. So the Fed cutting rates, Japanese bank raising rates, and we see commodities going higher. That will be inflationary for Japan, so it's going to be counterproductive for Japan anyways, and it's going to hurt the Fed, because they keep cutting rates, but commodities keep going higher, as we see the dollar being devalued. Important two takes from this. Gold will be a major benefactor of this dynamic. Number two, you can't have your cake and eat it too. So Jerome Powell somehow he wants to cut rates and ease the policy to rescue the economy and the stock market. But you want to do that without devaluation of the dollar? It has to be that way. And if you devalue the dollar, Bank of Japan or no Bank of Japan. But the Bank of Japan, of course, adds more fuel to the fire with the devaluation of the dollar. But even without that, devaluing the dollar means commodities go higher. And this is where the duality of the risk comes from. You devalue the dollar, you got a rise in commodities and inflation. And perhaps the greatest investor of all time, Warren Buffett, spotted all of this and said, you know what? Enough is enough. I'm out. I'm cashing out right now. And of course, Buffett, if we do an interview with him right now, he would say, well, you got to believe in the American economy and all of that bullshit just to assure investors, because that's his job. He's not going to speak with a negative tone against the economy, because last time he did that, they came with the long knives against him. But he sold almost half of his stake in Apple. And not just that, Berkshire Hathaway, selling shares like never before, raising cash as a result like never before, $277 billion in cash. Why? Because unlike Claudius Sahm and the bullshitters, Warren Buffett actually believes in his indicator. And right now, the Buffett indicator, you have market capitalization at 200% plus of the GDP. Major warning sign. And he tolerated this for a long time because maybe now we have some different things going on. But at some point, when the evidence begins to pile in, you gotta do something. And he's raising cash. He's waiting for the crash so he can scoop more and more assets. And this is why this man is the greatest investor of all time. Notice that he's timing the market. So when you see the talking heads on TV and CNBC saying, oh, timing the market is better than timing the market. Just keep your money with us so we can capture the commission and then screw you. Who cares what's going to happen to you later on? But no, the greatest investor of all time says time the market. He's not getting rid of everything because he bought Apple really cheap. But he is freeing up capital so he can scoop things cheaper. And to me, this is a confirmation of the top of the market. When Warren Buffett sells and we see all of the things that we talked about just right now, convince me with one thing. How do we make new highs now if the big caps have already peaked? AI, NVIDIA coming back again? Who? The IWM is going to rally by 100% every single day to replace the trillions of dollars added by the big caps? No, there's nothing else that can replace the big caps and NVIDIA once they go down. That's the weight problem that we've been talking about. And if that was not enough, from a technical lens alone, and give us some Hawaiian music with that, we got an island top, baby. An island top's one of the strongest confirmations of a top. We've seen them as a short-term top in the daily and hourly charts. This one is happening in the daily and the weekly charts. So it increases the odds that the top is already in. One more thing. You're going to hear in the next few days that you don't need to panic because corporate earnings are still good. I mean, look at Meta, look at Microsoft. They're still showing growth in revenue and net income. So corporations are doing fine. We don't need to panic. Let's go back to 2008. Microsoft, because Apple was a different company before the iPhone, but Microsoft was the leader in technology. In the year 2008, revenues for Microsoft were up 18.18%. The net income was up 25.7%. Despite all of that, the stock went down, losing about 60% of its value top to bottom. But you got to remember that even in the year 2009, during the heat of the recession, revenues were down only 3.2%, net income down, 17.6%, more notable. But again, nothing as a disaster as, a company lost 50% or 60% of net income. Despite all of that, the stock crashed. In the case of the dot-com bubble, the top and bottom lines for Microsoft actually went higher in the year 2000 over 1999. Despite all of that, the stock of Microsoft went down top to bottom by about 66.5%. What am I trying to convey to you here? The stock market is a psychological game, and you've seen how it reacts to the upside. Now you're about to see how it reacts to the downside based on psychology alone. The earnings will freak out about them. Then, when they come out later, they're not worse as expected. These stocks will find the bottom and recover. But that happens after these stocks get hit really, really hard because the narrative has changed, because the consumer is getting weaker, because the economy is heading into a recession, because other companies will indeed lose 60-70% of profits year on year. Warren Buffett understands all of that and says, okay, we'll look at the good companies later on after the crash and we'll deploy the cash and buy them. The last point before we move on. When we talk about the rotation now, what do? Because the risk-on rotation, aka the IWM and the small caps, was based on a false premise that we're going to see rate cuts for the good reasons. Soft landing. Well, that's not going to happen anymore. And we've seen the IWM going down along with yields going down because yields are going down for the wrong reasons. Folks are buying bonds because of fear of recession. And if we see a recovery in bond yields, that's not going to be good for the IWM either. So the worst rotation right now is the risk-on. The AI mania is weakening, as we said. Maybe NVIDIA has another trick up their sleeves. I doubt it. And the only rotation that is still here, or two rotations that are still here, the dumpster and the risk-off. And the dumpster, by the way, doesn't mean you sell everything. You can still buy bonds. You can buy gold. Those are still doing good when we have rotations to the dumpster. But you got the risk-off. And risk-off, dividend-paying stocks, value stocks actually did a lot better this week. They outperformed. So let's add more to this conversation and show you that in details by going over the market activities this week. We begin with the closing of the indices on Friday, and here we go. The diamonds closing in the red, down by 610.71 points, or a loss of 1.51%. The Nasdaq in the red, deep by 417.98 points, or a loss of 2.43%. The S&P 500 also down by 100.12 points, or a loss of 1.84%. And rest in peace to the small caps, Russell 2000 down by 7.66 points, or a loss of 3.54%. Look at these sectors on Friday. Believe it or not, defensives were actually at number one. They're closing positive, the only sector closing positive. Why? Because they're value and they pay a dividend. So when you have bond yields down and the dollar is not up, you got to understand that the money will stay within the market, will rotate, will try to look for something. And since the dollar was down, along with bond yields, then we have to look for high-quality dividend-paying names, and we found them in consumer staples. But you can see that utilities and real estate, also high dividend-paying sectors, they were down but not not by a lot. They were actually leading the market. What was down was consumer cyclicals, financials, technology, energy, anything that relates to the health of the economy was absolutely hammered. Look at the week all in all. Look at the contrast here, folks. You can read the headlines and the S&P's down whatever percentage points, the NASDAQ is crashing. That's the weight problem. But there are corners you can still play in the stock market. You need to rotate your portfolios to reflect that. You can see that this week, utilities was actually the leader of the market. Why? High dividend paying and defensive. Yields go down, you want to look for dividend paying. Okay, the dollar is not up, so the money's still in the market, so I'm going to look for dividend paying stocks. I'm going to look for high quality dividend paying stocks. Are folks going to dump their utilities all of a sudden, not pay the bill? No, they have to. At least for now. So utilities doing pretty good. Real estate is a really peculiar sector because you have high quality real estate names that are paying high dividend and those are being appreciated. But within real estate, you have the offices, the commercial real estate, the apartment buildings, the multifamily units. Those are going to crash. So you have to be selective within real estate. Not my favorite sector, by the way. I'm actually looking to short real estate, specifically in the commercial real estate, medical properties, that kind of thing. Then you have consumer defensives, that's the staples, high dividend paying names, also in the green. You got comm services, thank you Meta. Meta was still doing pretty good for the week. The laggards, once again, technology, cyclicals, financials, now you might say, but financials, Maverick, and energy, also high dividend paying stocks. The problem with these two is they suffer under the recession. So they're not high quality dividend paying. Loan growth is not going to be good in the recession for financials. Energy, if there's a recession, that's the enemy of energy. But on the other hand, you look at utilities, real estate, defensives, those can hold a lot better because they actually perform better as companies during the recession when costs go down, but the consumer can't let go of necessities like utilities, like food and consumer defensives. Look at the breadth on Friday, awful. The NYSE 16% advancing versus 83% declining. The NASDAQ 13% advancing versus 85% declining. And again, we were hopeful that the 52-week highs exceeding the 52-week lows will bring out something positive in the market, but now we're back to negative. We're seeing more 52-week lows than highs in both the NYSE and the NASDAQ because a lot of the rotation plays got killed. We'll look at the heat map on Friday again, pain across the board, but you see some green sectors. There are things you can still own and play. And it begins with the dividend-paying stocks. So you got telecoms, T-Mobile, AT&T, Verizon. You got the big pharma names, J&J, AbbVie. But you got to be careful with the stuff that went already higher, like Eli Lilly and Merck. Those are getting hit really hard. If you look at the insurance companies, UNH, that's doing pretty good, but I'll be careful with that because when we see the unemployment rate moving higher, also their revenues and profits will go down. You see other sectors in medical devices like Abbott, like Medtronic doing pretty good, like BDX doing pretty good, also dividend-paying stock. In industrials, everything is down, but you see the defensive dividend-paying stocks like the defense contractors, Lockheed, Northrop, Raytheon, or the waste management companies. You're not going to get rid of garbage in the economy. So waste management, you have Republic Services also doing pretty good. Utilities doing pretty good. Real estate, but notice that in real estate, the northern sector of real estate, like American Tower, like Crown Castle, those are doing okay because they're seen as stronger companies with high dividend. But the southern side of real estate, where we see the offices, the commercial real estate, been actually getting clobbered throughout the week. Metals getting hit throughout the week, even gold miners. And I've been saying, you want to go gold, go with the commodities, not with the miners. The miners will get hit too. Same goes for energy. All of them are down Friday, but Exxon is the one outperforming. So the only name right now with strength in energy is Exxon. You look at the defensives, as we talked, Procter & Gamble, Coca-Cola, PepsiCo, Mondelez, General Mills, Kraft Heinz, all of them lining up in the green, doing pretty good on Friday's session. Dividend paying, defensives, you want to stick with those. Then you have McDonald's, the king of defensives, dividend paying, doing pretty good. Now, you might say, but the earnings by McDonald's were not good, Maverick. So what is the deal here? Answer number one, dividend paying. Answer number two, as the economy deteriorates, sure, the numbers by McDonald's right now are not good, but they're shifting toward value to offer more and more cheaper options. And they know right now it's not going to do anything to help the company because the poor income consumer, the middle class consumer are getting hit. If you offer $5 meals, sure, maybe you'll increase a little bit of volume, but it ain't going to solve the company's problems. But as we see more and more higher income folks, we're not talking about the super wealthy here. We're talking about upper mid-income. As they begin to lose their jobs, as they begin to get hit with debt and all of that, you'll see them downgrading from dining out in restaurants to eating in McDonald's. And that increases the volume for McDonald's, and we see a recovery in the company. So that's why McDonald's do better under a recession than other stocks. Of course, we got the case of Apple closing positive, but the rest of big caps going down, including the chips and the AI mania. Now with the news that Big Buffett is dropping Apple by half, you'll see Apple down too. And we'll look at the heat map for the week all in all. You can see again, similar picture here. It's the same names, dividend paying names outperformed. The exception here is Meta, the only exception in the mega caps, because it is the best earnings report, at least so far, in the mega caps. But even Meta will get hit if we have weakness in the economy, because the investors will price in lower advertising spending. Now, I want you to pay attention here to MasterCard and Visa, because those two offer the only contradiction to the recession fear that we got this week. The earnings from MasterCard was pretty good. Visa, not so much. And even PayPal was pretty good. So we see these stocks going higher. Well, if MasterCard is doing pretty good, then somebody's spending in the economy still. So that's the only devil's advocate that we got this week. But the picture tells the story that investors are pulling back for anything cyclical, for anything that is risk on, anything that's been working, and they're going to safety, at least within the stock market right now. No panic, because we're not buying the dollar. We're not getting out of the market entirely. We're buying bonds, sure. We're buying gold, got it. We're also rotating within the stock market. Look at the heat map for the ETFs for the week. TLT up, meaning we're buying bonds, yields going down, but not helping the risk on yield-based or driven rotation, which is the IWM. That's down almost 7% for the week. The XHP home builders down big. The XBI biotech down big. The regional banks KRE down big, almost 10%. The risk off dividend-driven rotation or yield-driven rotation is doing pretty good. The XLP staples, the XLU utilities, the IYR real estate, but you got to be selective. Pick the individual names in the IYR if you must go that route. And the XLV, of course, same story. You got to be selective, because the XLV doing pretty good right now, but some names will go down. So you have to be selective within the XLV. The XLU and the XLP you can own, but I will even be more selective in the XLP. I will pick the individual names, high dividend, high quality, based on earnings. And of course, the other corner that is working right now is gold. So the GLD doing pretty good, SLV doing pretty good. The dollar is down, yields are down. Rush to safety. What's better than gold? Moving on to commodities, this is the action on Friday. So you have the Japanese yen up 2%, you got the dollar down 1%, so this is helping metals. So you see gold, silver, copper going up. You see even the grains going up, wheat, corn, soybean meal, even though soybean oil was the laggard. Not so good for energy though. And this is because the dollar is going down for the wrong reasons. The dollar is going down because of recession fears, because of anticipation of the Fed loosening the policy dramatically to remedy the recession risk. So I think that energy at the end of the day will move higher because it got geopolitics, number one. It got the devaluation of the dollar, number two. And number three, once the Fed cuts rates, that's going to be good for energy. So I think that energy is going to join those commodities that are lining up in the green. But needless to say, it was a recession-like reaction on Friday. Now, when we look at commodities and softs, you got cocoa and sugar down, but then we have cotton, OJ, coffee, and lumber all lighting up in the green. Now, I bought some coffee contracts on Friday. I think that we have a positive development coming in coffee as we see a breakout out of this consolidation range. We might move back to 240 if not above. But for now, I think as we talked with the Bank of Japan dynamic versus the Fed, commodities should do also good, but you have to understand that the recession fears will hammer energy and copper, lumber more than the rest. So gold, silver, some of the softs are more reliable right now until the cuts actually happen. Moving on to the big casino options, what do we see here? We see excessiveness in terms of the IV rank in certain names like Nvidia, like Intel, which suggests that we should be seeing rebounds, at least attempts for rebounds. We talked about this in Nvidia before, by the way, throughout the week. When we got to 100, we said, okay, this is a time where we close the puts and anticipate a rebound. But after a rebound, once the IV rank goes to the 80s, we're going to snap back to 100 again. But we see another leg down in Nvidia. This is exactly what happened. I think it will continue to happen. That as we see the IV rank at 100, we'll see rebounds, but until the dynamics change in the market, we're not going to see sustainable recoveries. We're just going to see mechanical recoveries because options pricing on one side went way haywire and out of whack. In this case, when you have the IV rank reaching 100, when the stock is going down, then we know that the puts are way too expensive to play. And that creates a mechanical rebound because when the puts become really, really expensive, what happens is folks who already own the puts, they book their profits under high IV. Only makes sense. And then we don't see folks following up and buying the puts. So we see a relief rebound because nobody's buying calls either, in a big way at least. So we don't see a sustainable rebound. But once the pricing becomes attractive in the puts, the stock goes down again. My 2 cents. I think that this time around we will find a footing this week and we will sustain a rebound better than last week. And the reason is I think that the data coming out of the economic calendar, specifically the services ISM coming out Monday, tomorrow, I think it will throw some cold water on the recession fears that you still have the services side of the economy doing pretty good. And that might give us relief in the dollar and in bond yields where they go higher. And with that, we see a recovery in the big caps, or what we call the high quality risk on rotation, not the IWM, that's shit quality. We're talking about the big caps where we can see a rebound. But the problem is the CPI. If the CPI comes out sticky and the economy is weakening, we could see panic again. So I see that, I know the futures are down right now, but I see that we recover initially. And then we see what happens with the CPI. If it comes out ugly or sticky, oh boy, we're going down again. And any rebound will be an opportunity to short. But right now, when I see puts in the 50s and high 40s, I'm thinking we're getting really, really close here for a rebound. We'll look at the flows, bullish flows versus bearish flows from the buy side. They're buying calls on the SOFR rate. This is a really interesting play, by the way. I want you to go to the comment section right now and let me know, why are they betting that we will see the SOFR rate going higher? I think there are a lot of folks who are not really calculating what's going to happen from this point on. I think folks are just betting on one outcome, that the economy gets weaker, we have rate cuts, but they're ignoring the other side of the risk, that we have a lot of surprises to come. And some of them will be, yes, we have pain. The economy is suffering, but we can't do anything about it. We might actually do the opposite. So keep that in mind. Then we see them buying calls in the VIX on Meta, AMD, Apple, Nvidia, the SOXL betting for a rebound in chips. But they're buying puts in the SPY, the index, crude oil, the cash index for the SPX and the S&P 500, the futures, ES, on Broadcom and the SMH. So we have contrarian plays here, where some folks are buying puts, others buying calls in the same names, the same sectors like chips. So what really matters is you dig into the details. Are they buying the calls in the short run? Are they buying the puts in the long run? If that is the case, they're betting for a short-term rebound, but in the long run, they see these names going down further. Looking at the bull versus bear flows on the sell side, they're closing puts on the IWM, the SPX, and the SPY, and the XSP, so the indices, the IVGO, Broadcom, UVXI, ARM. So they're betting on a rebound here in the way of closing the puts, booking profits from the puts. But the question becomes now, are they buying calls? And if they're not, then we can't really move higher, but we know that they're at least booking profits from the puts in these names. They're closing calls on Robinhood, on the E-mini futures, on Meta, on Apple, on Nvidia, on the TQs, and the SMCI. So that's also interesting, but again, you have to dig into the details. Option strat, 25% off, link in the description. Dig into it, do your homework. If you're trading a certain name, look at the flows on the buy side, on the sell side. What are they closing? What are they buying? Are they rolling from one side to the other, or just rolling the strikes up or down? All of these things matter in predicting how each individual stock or security will trade one way or the other. Let's do some of the unusual trades that took place on Friday. Here we have a long call in the VIX, buying the 45 calls with the expiration date September 18th, meaning VIX 45 and above by September. Spending about $3.5 million on those. I think the VIX will make all-time highs when this is all said and done. But I think in the short run, we see a pullback in the VIX, then a spike higher again. Here's one that's really interesting. They're buying calls on Lockheed Martin. The 600 calls with the expiration date of November 15th. Spending about a little over $400,000. It adds with what we've been talking about, the geopolitical risk. And it's a reliable name under these circumstances. Good business, showing profits, showing revenue, paying dividend. So it is a resource of safety at this point. Then we have calls on the SOXL. This is the levered bullish index for the SOXX, which is the semiconductor ETF. Basically, they're betting for a rebound in chips. And I agree. I think we'll see a rebound in chips this week. They bought the 33 calls, expiration date August 9th. So they're not going way too far. They're betting for a short-term rebound. I agree with that. And they're paying a little over $1 million. They're also betting for rebounds in the airliners. In this case, they bought UAL calls, United Airlines. They bought the 44 calls and the 50 for the expiration date of September 20th, spending about $1.5 million. Something going on here with the airlines, jet fuel going down, government bailouts, M&A, what's going on here? Maybe they'll get some compensation from CrowdStrike, because they're buying the calls on Delta Airlines too. The 44 calls, same expiration date, September 20th, spending about $1.7 million. I disagree. I think in a recession, airliners would go down. A lot of them will suffer, maybe go bankrupt altogether. But somebody here is seeing a positive catalyst coming out really soon. Looking at the bearish unusual trades, how about AVGO Broadcom? Somebody bought the 125 puts for the expiration date, September 20th, spending about $2.5 million. Again, part of the AI mania, overvalued, if we see weakness in the economy. These names are going down. I look at them as an opportunity to short, meaning borrow the shares. I'm actually beginning to short stocks right now. The puts, you can play them and trade them, or you can trade the calls, I think, in the near term in the chips. That's okay, but at the end of the day, where are they heading later? And I think right now, since we got a confirmation at the top, I'm beginning to open shorts in these names. Actual shorts, not the put options. Sometimes you can enter the actual shorts via put options. So you buy the puts if they expire in the money, you exercise and you short the name at your desired price. They're buying puts on the IWM, the 199 puts, expiration date September 20, spending about $2.25 million. Now that we have the worst of two worlds in the small caps, if yields go down, they're going down for the wrong reasons. If they're going up, that's not good for the IWM either, so it suffers either way. Then we have somebody buying puts on PANW, Palo Alto Networks. They bought the 280 puts, expiration date December 20th, spending about $1.25 million. Maybe regulations coming after the CrowdStrike disaster, who knows? And finally, this is a really interesting trade. In the know, this is an insider trade. So somebody sold the 45 calls. Somebody owns the stock, of course. Sold the 45 calls, covered calls, to finance buying the 35 puts. On the stock ESTA, this is called a short combo, and the company is Establishment Labs, spending a little over $300,000. This is a company that does the breast implants. The trade doesn't make sense to me because I thought that Sydney Sweeney brought the big boobies back. It used to be the big butts with the Kardashians, but right now that's fading away as a trend. So all of the implants that you've done and the squatting, forget about it. Now it's out of fashion. Now guys are looking for the big bazookas upstairs, not downstairs. Bringing the 90s back, or was it the 80s? I don't know. Anyhow, somebody here disagrees. They're actually betting on deflation in breast size. Let's move on to the charts and then wrap it up, folks. We begin with SPY, the S&P 500. This is an hourly chart. What do we see here? Right off the gate. In this program, we talked about the importance of 547. It's been a point of rejection over and over and over and over again. Well, if you can't beat it, you can cheat. And the chart did cheat by gapping above. But then we said if we go all the way to 555, I'm taking a short. And we took a short. Once we closed below 547 was a confirmation for lower lows. Well, we flushed all the way down to 529. We found some support on Friday. It was a mechanical support in my opinion. Now, if you look at it from the bearish lens, this is a bear flag pattern suggesting that we have more declines to come. If you look at it from the bullish lens, look at the wave in the MACD. The wave is bottoming. It's getting super negative, and we have no doubt about it, a correction in the wave from bearish to bullish. It doesn't mean that it has to go above the zero line and give us a confirmation, because it gave us false confirmation when we got to 555, by the way. But it means that at least we might do as the previous two attempts for at least a rebound, where you see the green columns showing up in the histogram, but you're not really crossing above the zero line in the hourly. And then we go down, forming red impressions in the histogram again. Which side has the better argument? Well, we have to look at the daily chart. So we know that we have support at the lower Bollinger Bands. We know that we have support at the 100 days moving average in red. At the same time, we're not oversold in the hour side. We're not oversold in the MACD. So I would say in the near term, the rebound crowd has the upper hand because we got support at the 100 at the lower Bollinger Bands. But the more correction to come crowd has the advantage in the long run because we're not oversold yet. So we have room to go down if we want to go down. Then we have to zoom out a little bit more and use the Fibonacci retracement lines. We're at support right now, 528.36. So we got the support of the Fibonacci, of the lower Bollinger Bands, of the 100 days moving average. I think this is a point where the market should, keyword should, find a footing. And then, of course, plug it all together. If we find a footing with a rebound to close the gap or whatever, and then we go down and we lose the 100 days moving average in red, and we lose the Fibonacci support of 528.36, and that's going to be a confirmation for a resumption of the correction. What supports you in the resumption of the correction is the weekly chart of the cash index, the SPX. We have broken trend, and you look at the wave in the MACD. Bullish wave began all the way since the bottom in 22. We were about to go in a correction into a bear market, as you can see in the fourth quarter of 23, but then came the rescue by Powell, the promise of rate cuts. And we've initiated a resumption of the bull leg. At some point, the bull leg dies. We have no confirmation that it's going to a bearish phase because we're not below the zero line in the MACD, but at least we have a confirmation that we are in a corrective phase of that leg. Now, my 2 cents, I think we go to a bear phase, no doubt about it, and the wave dies, but I'm taking it one step at a time. For now, if this continues, if we don't see a recovery above the weekly trend line, then we're going to go with the same thing, that any rebounds in the daily will be opportunities to sell because we're not done with the correction yet. And I see a reliable rebound in the weekly chart coming at 4,953.56. If we get there, I think in the weekly MACD we'll be at the zero line, which we usually see an attempt for a rescue. If we dip down into the negative territory in the weekly MACD, and we lose 4,953.56, that's going to be a confirmation for the bear phase of more pain to come. Significant more pain. Look at the Qs, the NASDAQ hourly chart, the same dynamic with the SPY. We got a false breakout. We hit almost the 474 line, 475, couldn't close the gap fair and square, and we flushed down. Now you can look at it from the bearish way and say that we have a bear flag and down we go. You look at it from the bullish lens and say, but the wave is already negative. We should be finding a footing here and a rebound. Just a rebound. We're not looking for a resumption of the bullish phase. Just a rebound. Who has the better evidence? Looking at the daily chart for the Qs, we're below the 100 days moving average, and the Q's been a leading indicator for the SPY, by the way. So if this one loses the 100, the SPY is next. That's a warning sign. But for now, are we oversold in the hour sign, the MACD? Getting there. Okay, so that's supportive of a rebound to come this week. We're at the lower Bollinger Bands. That's also supportive of a rebound to come. We zoom out and plug in our Fibonacci support. We got 441.95. You can call it 442. My number is 443. Doesn't matter. The point is, rebound is coming. We're not going to flush in a straight line. Rebound is coming. So short term, the rebound crowd has the upper hand, in my opinion. But in the longer term, even in the daily chart, you see confirmation of the topping head and shoulder. Suppose you get a rebound in the short run. You close the gap, you go to 450, or 455. Then you come down. Once you break below 441.95, you got more pain to come. And that pain, by the way, will take us down to the next Fibonacci, maybe at 423. But if we continue to get weaker, remember that we have a gap that goes all the way since the fourth quarter of last year, as I'm highlighting right now. I think if this is indeed a shift from bull wave to bear wave in the weekly, that we're going to go down to close this gap. And that would be in or around 377. Take it one step at a time, folks. Looking at the NASDAQ futures hourly chart, we talked about the false breakouts up and down. But at the end of the day, we're going to follow the real breakout, which is the first one. That's indeed what happened. Right now, I think that we way oversold. I know that we're gapping down overnight, but I think that the case for a rebound is getting stronger because you look at the MACD from the hourly time frame. It wants to shift from bearish to bullish. So I think I would not be surprised that if I wake up in the morning, I would see the futures actually trading in the green. That maybe after the ISM, the services ISM, we'll find a footing in the NASDAQ. But the problem here, folks, zoom out to the daily chart. We lost the 100. So unless you have a closing above the 100, you're not going to have a recovery. Even if you close above the 100, you still need to close above the shoulder line before you confirm any recovery. So for now, we go to the weekly chart for the NDX. We lost the trend on the weekly. We're at the Fibonacci support of 18,271.89. Sure, let's get a rebound on the daily. Got it. If we come back down again and we lose that Fibonacci support, then we're going to go down, and that will be the confirmation that the bull wave that you see in the MACD that began all the way back to 22 will be done and over because we go down to negative territory below zero. If that is the case, once again, you will see sharper correction in the NASDAQ, and it'll happen so fast. We'll be at 14,000 at some point. Look at the IWM small caps daily chart. What do we see here? We talked about the Fibonacci not being violated, and we see a formation of a bear flag. Indeed, the bear flag played out. Confirmation in the MACD, as we see the red impressions in Instagram showing up. The negative divergence in the RSIs I'm highlighting. The confirmation of the crossing of the red line over the blue in the vortex indicator. All of these indicators are saying that we're now bearish on the IWM. We got another Fibonacci support at around 201.82. I think we're going to reach that number and then see what happens. But that means we've erased the entirety of the rate cut optimism / rotation bullshit. Looking at the dollar, flushing down, losing the 20 days moving average, losing the support of 104.80 basis points, but it is getting oversold, folks. And I think that the services PMI could be the catalyst to give us a rebound in the dollar. But the dollar is heading down long run. The Fed has no choice but to devalue the dollar. And the Bank of Japan has no other choice but to continue to fluff up the yen by raising rates higher. So that means that whatever rebounds in the dollar will be sold right away. If that is the case, by the way, we don't have an inverse head and shoulder anymore in the dollar. If that is the case, is that good or bad for the old man gold? I think it is good. And we're now above the previous highs. You see the MACD now turning positive, and we can clean up the chart a little bit and look at it from the perspective of cup and handle breakout. You can go with the SLV silver. That's up to you. Not my favorite play. I'd love to be in gold, not silver. I use silver as a hedge against my gold portfolio. But right now, since you're above the 100 days moving average in red, so far, so good. You lose 26 in the SLV, forget about it. If you want to play precious metals, please stick with gold, not silver. If you look at crude oil, reaching and violating the Fibonacci support, not looking pretty good. Can go further to the downside. We can form a gigantic ABC pattern and go below 70. But my 2 cents with the geopolitical fears, with knowing rate cuts will happen and the devaluation of the dollar will happen and the revival of inflation will happen, we'll see a rebound in inflation, I think we'll find buyers in crude oil. But you got to be really careful right now and hedge. I always do that. Every time we have a recession fear, I got exposure to energy. I hedge right away, put options. That's the easiest way. In case your stocks crash, again, whether you have energy portfolio or any portfolio, when you buy the puts, if your stocks crash, you preserve the right to sell at a certain price by exercising your put options. So you got to utilize them, folks. Here's the other thing I want to show you. XOM, ExxonMobil in white. You got the XLE energy stocks in orange. Who's outperforming right now? It's Exxon. It's trending higher. The XLE is trending down. Can the weight of the XLE drag XOM down? Sure. But I think we'll see a rebound in crude oil and Exxon will actually continue to go higher and lead a recovery in the XLE. So for now, ExxonMobil, what I'm trying to show you right now, ExxonMobil is the number one play in energy right now. The safest play in energy is ExxonMobil. Looking at the 10-year yield collapse, but overdone? Yes, it is overdone. This is panicky. This is saying, hey, Powell, you didn't cut, so we didn't cut for you. Recession is already happening. I think once you get the services ISM or any good piece of data, you'll see a rebound in yields. Now, it ain't going to help the IWM. It ain't going to help the risk-on rotation. But it's going to help who? It's going to help the big caps forming a rebound because, okay, now we can breathe a sigh of relief that yes, recession is coming, but not as immediate as we thought last week. What you really need to look at is this ratio, and this is how we predicted, by the way, that the rebound is a false rebound that we got during this week. You look at the ratio of the 2-year versus 10 in white, and if we're dropping down, meaning the 2-year is underperforming the 10, then the NASDAQ will come down. If you begin to see us trending higher, as the 2 years outperforming the 10, then you see the NASDAQ going higher. And this is a proof, ladies and gentlemen, that we're now in the bad news is bad news, good news is good news. Meaning the market actually doesn't want rate cuts because it's looking for an improvement in the 2-year to the 10. That's when it trends higher. If the 2 goes down relative to the 10, meaning rate cuts and re-steepening of the yield curve, that's what the market doesn't like. That's the proof that we are in good news, bad news, bad news. You look at the XHB, yield-sensitive home builders. Again, recession fears with yields going down, not good for it. Yields going higher, also not good for it. So the XHB suffers from the same problem as the IWM. The IYR performed a lot better because it has some high-quality dividend-paying names. But with yields going down, that was good for the larger names in the IWM. Or excuse me, the IYR. I'm sorry. If we begin to see a recovery in yields as in the form of a rebound, you will see the IYR actually pulling back and you see a rotation out of these dividend-paying names into the big caps. You look at the KRE regional banks, again, same story as the IWM. Yields going down for the wrong reasons, not good for the regionals. And yields going back up, also not good for the regionals. So you got to avoid it in a rebound here. You got to short it. You look at the VIX. We talked about the Christopher Nolan thing. In the market, it was an inverse ABC within an inverse ABC. In the VIX, it's an ABC within an ABC, and we see the ABC played out. Got a little toppy, a little overbought on Friday's session, and we called it in the live stream that we're going to head down. And indeed, we headed down. Now comes to the weekly chart, and every time we close above the 20 weeks moving average, that was my signal to buy the VIX and to bet on a market correction every single time. But we got to be reasonable here, folks. Every time we see a violation of the upper Bollinger Bands in the weekly chart, we see the VIX pulling back. My bet this week, we see the VIX pulling back, recocking the gun, and then moving higher again. We'll look at Apple, Big Kahuna. What do we see here? Hourly chart. It kind of flushed down at the end of the day and closing below 220. That's not a good outcome for the Big Kahuna. Of course, with Warren Buffett dumping, we'll see a violation of 215. My 2 cents on Friday was, hey, Apple is showing relative outperformance. But after the Buffett news, I don't think that relative outperformance will stick. You look at the daily chart for Apple, rejection off the 20 days moving average, and a confirmation of a topping in the shoulder, aka the top is already in. You look at Tesla, daily chart for the souffle. We talked about the bear flag. Bear flag played out, got support in the 50 days moving average in blue. If you break the blue line, the 50 days moving average, on Monday's session, on Tuesday's session, not gapping below, but breaking it, if we open flattish, assuming, then you have more room to the downside. And I say that because if you clean up the chart and you plug in the Bollinger Bands or add the support of the lower Bollinger Bands, we're expanding them to the downside, which means that short term we might find a rebound from the lower Bollinger Bands. But in the long run, we're expanding the bands lower so we can allow the chart to head lower. If you look at NVIDIA daily chart, add the support of the lower Bollinger Bands, but that came after a nasty rejection at the 20/the 50 days moving averages, 20 in white, 50 in blue. We got the good news here, the rebound off the 100 days moving average in red. So we got 2 supports, lower Bollinger Bands at the 100. We got 2 resistance lines at the 20 and the 50. So we're stuck in a range here. Confirmation to enter more shorts in NVIDIA, or new shorts if you'd like. You got to close below the 100 days moving average. Confirmation you go long, you got to close above the 20 days days moving average. Otherwise, it could be a dead cat rebound again. Just zoom into the hourly chart. We called the dead cat confirmation, by the way, in the morning brief before it happened. If we lose 117 from a 1 hour chart perspective, that'll be a confirmation for the dead cat bounce. We go with the puts for NVIDIA. But then comes Friday's session. You got to close these puts because we're getting a little oversold. And we have support the 100 days moving average. If we lose the 100, we can open more shorts. But my 2 cents would be that we see a rebound first in NVIDIA. Then we might open the path for more downside. Because right now we can argue that we have a double bottom too. Lastly, tulips. Bitcoin, what do we see here? We got a violation of the 63,000 support. So now we have a bearish confirmation. You can see it in the MACD, you can see it in the vortex indicator, and a confirmation of the topping head and shoulder formation. Here's my fear with Bitcoin, or let's say my signal that we should be short, because at the beginning of the week it was given the benefit of the doubt. Maybe we'll be at 71,500, I'm sorry. But once we lose 63,000, you got a confirmation for a head and shoulder top. And moreover, perhaps more important, we look at the weekly chart. We got a rejection from the sloping line of resistance. We have negative/bearish weekly momentum in the MACD indicator. We have a pattern of lower highs and lower lows. This is a confirmation that Bitcoin will make a lower low. The question is where? 50,000? Maybe. 55,000? 45,000? That's up for grabs. Can't speculate on that, but we know that we have a lower low coming in Bitcoin. Lastly, moving on to the conclusion of this video. What do we have on the economic calendar this week? We begin with tomorrow, the 5th of August, the U.S. Services PMI and the ISM Services rating. That could be the savior if we see that the pace of economic activities and services are actually going positive month on month. You'll see a rebound in the dollar and bond yields, but the stock market, aka the big caps, will rebound with it. Why? Because now we're looking for good news as good news. Then comes Tuesday the 6th, we have the trade deficit. Wednesday the 7th, we have consumer credit. Thursday the 8th, we have initial jobless claims and wholesale inventories. But we have nothing going on Friday the 9th. I think it will be a good week for a rebound in the equities market led by the chips and the big caps. But boy, the week after that, when the CPI comes out showing sticky inflation and the economy heading into a recession, you combine both, we will see a crash right away. One step at a time, folks. What do we have on the earnings calendar? We have important names from Eli Lilly, Amgen, Disney, Caterpillar, Uber, Gilead, Airbnb. But we have more than those. We have Super Microcomputer, which will be one of the most important earnings, AI. But folks, I'm already exhausted here. Long show, but a lot to discuss. Important week, and more important weeks to come. Hope you enjoyed the show, and if you did, return the favor by pressing the like button, leaving us a nice comment in the section, participating in the conversation, and subscribing to the channel, and better yet, becoming a member. You support the channel, and you get access to the daily videos and more bonus videos, Discord benefits. We do a lot of work, so it is worth it. But with that, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
I don't want to win an Oscar, and I don't want to reinvent the wheel. I like simple pleasures like butter in my ass, lollipops in my mouth. That's just me. That's just something that I enjoy. Call me crazy, call me a pervert. But here's one little thing that I want to do in this life, and that is I want to make $1.01 in this business.